Hey, what's up everyone? Welcome back to the channel. Today we are going to break down the concept of liquidity. What is liquidity? Why is it important? And why it's important to measure liquidity when deciding where to store your money. Here is a real life scenario. Let's say your car breaks down on a Monday morning. The repair shop says it'll cost $800 and they need it today. However, you don't have any cash at the moment yet. You've got $800 worth of stocks sitting in your investment app, but the money won't hit your bank account for 2 business days. You have the money, but you can't actually use it right now. That gap between having value and being able to actually spend it, that's a liquidity problem. And it happens to regular people, big companies, and even entire economies. So first things first, what is liquidity? Liquidity is simply how quickly and easily you can convert something into cash without losing its value. That's it. That's the whole definition. Think of it like this. You've got cash in your wallet. That's 100% liquid. You hand it over, done, instant. You've got stocks in your brokerage account, also pretty liquid. You click sell, and in a couple of days, boom, cash in hand. You've got a house, not very liquid at all. You've got to list it, find a buyer, negotiate, do inspections, deal with lawyers. We're talking months. And then there's your Pokemon card collection. Don't laugh. Some of those are worth serious money, but finding the right buyer at the right price, that could take forever. So the spectrum of liquidity goes from cash on one end all the way down to rare collectibles and real estate on the other. The faster and easier it is to sell something for full value, the more liquid it is. Now, why does liquidity matter? Here's why. Life doesn't always give you a warning. Imagine you lose your job tomorrow, or your car breaks down, or, and this one's fun, you find the perfect apartment and you need a deposit by Friday. If all your money is locked up in a piece of land you bought in the middle of nowhere, now you're stuck. This is why financial advisors always talk about an emergency fund, keeping 3 to 6 months of expenses in cold, hard cash or a savings account. Because when life hits you, you need something liquid. Now flip it to the world of investing. Here's the trade-off that every investor has to deal with. Liquid assets, like stocks or cash, are easy to access, but they tend to offer lower returns. Illiquid assets, like real estate, private businesses, or fine art, can offer higher returns, but your money is locked up for potentially years. This is called the liquidity premium. Investors demand a higher reward for agreeing to lock their money away. Basically, higher risk, higher reward, right? So when you're building wealth, you've got to balance it. Some liquid assets for safety and flexibility, some illiquid assets for potentially bigger gains. Now let's zoom out for a second now, because liquidity doesn't just affect you, it affects entire markets and even whole economies. Ever heard the phrase, the market dried up? That's a liquidity crisis. It means there aren't enough buyers and sellers actively trading, so things grind to a halt. Remember the 2008 financial crisis? Banks issued high-risk subprime loans to borrowers with poor credit. As a result, people defaulted on their mortgage payments while banks believed the opposite. That created a liquidity crunch. Banks couldn't sell their assets fast enough to cover what they owed. Everything froze. That's why central banks, the Federal Reserve in the US, sometimes inject liquidity into the economy. That basically means they make it easier for money to flow around the system so banks can keep lending and businesses can keep running. This is not always a good thing. This could result in inflation if there is an imbalance between demand and supply. But that's a discussion for another video. Think of the economy like a giant machine. Liquidity is the oil in that machine. When there's enough of it, everything runs smoothly. When it dries up, things start grinding, heating up, and eventually breaking. All right, let's go just a little bit nerd mode for 30 seconds. I promise it's worth it. Companies measure their own liquidity using something called liquidity ratios. The two big ones are the current ratio and the quick ratio. The current ratio equals to current assets divided by current liabilities. If a company has $2 in easy to sell stuff for every $1 it owes in the short term, that's a healthy ratio. It means they can pay their bills. Now, the quick ratio, same idea, but inventory is not accounted for because inventory isn't always easy to sell fast. If these ratios drop too low, well, red flag. That company might not be able to pay what it owes, which is not great. So if you're ever looking at stocks and you want to check on liquidity health, these ratios are your friends. All right, let's recap what we discussed today. Liquidity means how fast you can turn something into cash without losing value. High liquidity, easy access, lower risk, but usually lower returns. Low liquidity, harder to access, higher risk, but potentially higher rewards. And whether we're talking about your personal savings, your investment portfolio, or the entire global economy, liquidity is always quietly running the show in the background. Next time you hear someone say, cash is king, now you know exactly why. If you found this helpful, drop a like, subscribe if you're new, and let me know in the comments. What finance topic do you want me to break down next? See you in the next one.